All right, good afternoon and welcome to today's webinar on trends in Wirehouse advisor compensation. My name is Tim Kehrer. I'm with Kehrer Bielan Research and Consulting. We're pleased to be hosting today's event. Before we get started, I'd like to take a moment to thank our sponsors, without whom today's webinar wouldn't be possible. Our sponsors today are WealthVest, Citi Cross Asset Solutions. We're also thankful for the support from our friends at Terrapin Technology and Delaware Life. Thanks to all of you. This is, I believe, our 20th webinar that we've held since the start of the COVID-19 crisis. I think that's a few more than any of us would have predicted we would have ever held. Certainly, to think that we've done all that, in the space of less than a year, would have shocked us. We've learned a few things in that experience, and one of them is that trying to recreate the kind of interactive idea sharing environment that we sought to build through our in-person study groups is really hard to recreate in a virtual setting. But we've experimented at it a few different ways, and we think we've gotten pretty good. Here's how today is going to work. We've invited a few of your peers to join us on the screen. I'm sharing my screen right now, which I know means you can only see some of us. I'm going to introduce them, and as I do that, I'm going to go ahead and stop sharing the screen. But the information that you're looking at now will be available after the fact. So joining us today on your screen are Frank Consolo from Citibank, Larry Key, currently a free agent, formerly of Wells Fargo, Kevin McCarthy from Truist, Tom Mudliff from United Brokerage Services, excuse me, Frederick S. Nicholas III, Fred.
That's fine.
Yinglu Zhang from Citi Cross Asset Solutions. We also have a couple of other members of the Kehrer Bielan team on your screen today. Our principals, Kenneth Kehrer and Peter Bielan. And maybe most importantly, we have all of you that aren't on the screen. And this is really where we get back to the idea of the kind of interaction and idea sharing that I was talking about before. We find these sessions are so much more valuable when you in the audience participate, when you send us your questions and comments. We've given you a couple of ways to do that today. One is by using the chat function. There's a button at the bottom of your screen that'll allow you to send us your questions via chat. All of us on the panel will be able to see those, and I and Ken and Peter will do our best to bring them into the conversation as they fit. But the best way to get involved, if you can, is by raising your hand. That's also a button at the bottom of your screen. That'll actually allow you to join our panel on the screen through audio and video as well, if you're set up to do that. That'll allow you to kind of have any back and forth that you'd like with the panelists and really make sure that, that you get your question answered. With that, thanks again to everybody for joining. And I think Peter is going to kick us off. Peter.
Yes, thanks, Tim. Good afternoon, everyone. Thank you so much for joining. And the first of likely many virtual roundtables that we do, at least the first half of this year. And this one is really as billed, and it's to help us understand what wirehouses are doing with their compensation. And there was a flurry of activity at the end of last year, a little bit at the beginning of this year, on what changes they're making. And we think as an organization that it's very important to know what those changes are and why they're making those changes, because we compete in many cases for those same advisors, either from that Wirehouse, or some of our advisors, are unfortunately being approached by wirehouses. So to understand what they're doing from a compensation standpoint is important. But also because if you look at the resources that they all put into analyzing the compensation of how they pay advisors and the stakes of getting that right, or the difficulty if they get that wrong, based on the investment that they put into that, there's something that we should be able to learn from all that and be able to apply it in our world with our advisors in our environments and take the best ideas from that and really build on those of things that'll work to help our business the way we want it to turn out. So that's what this virtual dialogue is about today. We're going to cover a lot of what we see Wirehouses doing, and then the virtual panel that's on screen can really give their thoughts and opinions on that, how it would work in a bank environment, if they've tried it, successes, difficulties they've seen with it. And then also any of you in the audience, having had experience with any of these ideas, are more than welcome to chime in via the way the ways that Tim mentioned. So it's truly set up as a roundtable. I know we're in 50 different cities, but it's as roundtable-ish as we can get in 2021. So that's the plan here for this afternoon, and let's get started. So Tim, will you advance us to, there we go. All right. So I thought, first of all, let's take a look at Merrill Lynch to understand their firm a little bit, what their advisor base looks like, and get some ideas on compensation. So Merrill Lynch brought in 22,000 net new households, 1.3 net new household per advisor. It's net, but I mean it's 1.3. So not a big number. Now their criteria for a household is greater than $250,000. So it isn't any household, but it's 1.3 per advisor. 2.8 trillion in retail investment assets. That's 162 million per advisor. 18 billion in net new assets. Just over 1 million per advisor. And this is last year data for Merrill. 107,000 referred bank accounts, 6.2 per advisor. 306 billion in sweep deposits. That's total. So almost 18 billion per advisor. And that's in addition to the 162 million per advisor. They have 17,000 plus advisors doing it's 1.17 million average production per advisor. Okay, so just to give you an idea of what they look like in their book and all, I wanted to put that out there. Okay. All right, Tim. So let's move to the next one and go over some key components of their plan. So they pay 40% at 500,000. I just put these two touch points in. 42% at $1 million. Not all that significantly higher than what I would see in many bank programs. Actually, at $1 million, there's some bank programs that pay more than 42% at $1 million. Now, this is what they've really hung their hat on these last couple of years. This has been out there about 3 years now. I think maybe this year's the 4th year, but this is what they've really hung their hat on as far as changing their compensation. And what they do is they have an asset level that if assets are up less than 2.5% in total for that advisor, or they don't add 3 affluent households, an affluent household is 250,000 in the total relationship, investments, deposits, loans, the grid decreases by 2%. And that's at all levels. So, their incentive, other than the grid, is really based on new assets of a targeted client, and they pull from the grid if you don't hit that level. The other part of it is if assets are up 5% and they add at least 5 new households, in that same category, the grid increases at all levels by 2%. Okay, so that gets you, to 44 and $1 million, which is probably closer to what banks pay. And then there's that one last sentence in there that I think is important, and hopefully we get some discussion around it, is with the qualifier of 2 affluent household referrals to banking. So that's their give back to the retail side of the bank, is that, the advisors in this category of assets being up 5% and 5 new households don't get that 2% increase unless they add 2 affluent households to retail banking. Okay, so there's a lot in there. There's the grid, there's the, decreasing from the grid, increasing from the grid, and then the banking side of it. So let me start by really putting it out to the virtual panel here. Have you all tried this in any instances and have any input on how it worked or anything similar to this?
Peter,
Peter,
oh, go ahead.
Go ahead, please.
The couple takeaways I have from this is the 40% and the 42% is very consistent with what we're doing. So I do feel competitive about that. The referrals, no, I'm sure that's a little bit missed in the size of the numbers, but 6.2 referrals is pretty low. So I feel we're actually doing pretty well compared to the number of referrals our advisors are getting. We do not do any subtraction or enhancement to the grid based on some of those metrics. I mean, our philosophy is if you're getting referrals from the bank, you should be referring back to the bank. That's part of your job, and we don't incent or penalize you for that. And we don't really have an asset growth number. We set goals, and while you don't get paid according to goal attainment, everybody's goal went up a minimum of 10% year over year as part of our goal setting process. And our thought there was between insurance, natural growth of your existing book, and things like that, everybody should be able to achieve 10%.
Right, one way or another.
Just doing their job.
Okay. All right, Kevin, did you have a comment on that?
Yeah, I'll jump in. Good afternoon, everybody. So we have tried similar type things, I would say, with a twist. We've always kept the grid pure. So we didn't have any add or subtract based on these factors, but we did offer our advisors an annual bonus. And so we really looked at a few different components of that bonus historically. One was on net new assets, so fee-based business. Another was on new target clients. And so very similar to Merrill Lynch. Our definition of a target client was either $250,000 if you were a branch-based advisor, or $1 million or more if you happen to be working with some of the wealth teams. And then the other thing that we tried to encourage was more of the business mix. So what does your book look like? So we incented people for having a certain percentage of their overall relationships above a certain dollar amount. So it was all additive, much like the previous comment in terms of referring back. We don't pay for doing that, anything additional. We do feel like that's part of being part of the overall banking organization, and you should give back.
So Kevin, you all, it sounds like, have really tried to make your rewards dependent upon a larger client, a larger book size. You're trying to get them to move upstream with what you described.
We have. We have moved that. We're in the middle of a merger right now. So we've moved away from that this year. We'll revisit that again in 2022. But historically, we have done that at SunTrust, and it's worked very well.
Okay, nice.
Peter, if you could make a distinction for us, none of the Merrill Lynch advisors, right, reside in any of the branches. They might be assigned to them, but they don't reside in them, right?
They don't. Now, these are not Merrill Edge advisors. We'll talk about Merrill Edge a little bit later in this, but this is the traditional Wirehouse, freestanding office with 40 advisors and that don't have much at all contact with the branch, with the bank branch. The only time they would get clients from a bank branch is if it were sourced through a Merrill Edge advisor. Because Merrill Edge advisors can't handle under 250. So this isn't an apples to apples to our typical in-branch advisor. It's more of an idea so that we can see what firms are paying those advisors that self-source business, because we're going to have to think a lot more about self-sourcing business based on branch referrals or the lack thereof.
There's no doubt about that, but not to get carried away with the distinction, but I think that these Merrill Lynch advisors who do not reside in Bank of America branches didn't do so pre-COVID either. I think that was, by design structurally, if I'm correct on that.
They weren't in branches pre-COVID. Right. No, they're freestanding. I mean, this is the traditional Merrill advisor that's a freestanding, in a freestanding office with 40 other advisors,
Right.
Producing whatever business they can. Yeah.
Right.
But they're still being incented to drive business to banking.
Well, B of A owns them.
That's right. Yep. Mm-hmm.
I mean, and then if you talk to a Merrill, if you talk to Merrill advisors, which I do, I mean, they still don't like the fact that, that they're bought by a bank because they have to provide, 2 affluent household referrals a year or something like that to banking, because it's, that to them seems very, like a very high hurdle. And if you look at what, many of our bank advisors provide back to their, their retail counterparts, it's significantly more than this.
Hey, Peter, it's Frank. We at Citi, we do
Frank.
we don't pay anybody under 200,000, but we look at D&I, right? So we look at the entire relationship, and if it's under 200, they don't get paid. So there's a real incentive to give those clients up and send them to what we call priority rep, which is like a centralized, almost like a call center. They can keep them and do business, they're just not getting paid on it. Number 2, we pay people mortgages, cash, not to the grid, and we also pay them on margin and non-purpose lending. So that helps to foster that partnership with, making referrals with partners. And then the last thing, we did some major changes this year. We went to a quarterly payout instead of a monthly. Our grid is similar to what you showed there. It's actually higher than that. At $1 million, we're at about 44. Used to be 46, but we took 6 points off the grid this year and we put it into a discretionary payment. And that payment rewards things like planning, insurance, fiduciary, managed assets. We have like 7 criteria we use, and partnership is one of them. So the manager now, their direct manager, will have input in determining that 6% is theirs if they meet. We didn't put numeric goals, but kind of leave it up to the manager. Intent is to pay it, but it will incentivize the advisor to be, be a partner and work with their teams.
Okay. Good.
I was going to mention, one of the things that I've seen and we keep hearing about, and we worked with McKinsey when we did our rollout, and that was, there's opportunity, and firms are trying to figure out how do you put some discretion into a plan so that you can get, incentivize advisors to do the rest of it besides the risk management and the revenue piece. How do you foster that affluent, bank cross-sell to bank? How do you do mortgages and lending products? So in our world, if we count the D&I for the account, so if a client has, $100,000 and let's say it's a managed account, if they can get another 100 in CDs or bank products or lending, they then qualify to upgrade that 200 or more, and they'll get paid on it. So that's kind of how we fostered that without paying directly. And we just say, hey, we'll count the D&I towards the at the segment level for the client.
Yeah, so I think a lot of what you're saying there, Frank, is that you all are really trying to incorporate both investments and deposits and loans into what this advisor is doing. It's important to them.
Yep.
And it's
And-
proven in the compensation.
Yes, and the other thing I didn't mention is, I mean, we're a big believer in teams. So we've got teams of advisors, but then we also have what we call a dedicated team, which is a relationship manager that's teamed up with an FA.
Mhm.
And the two of them both share in each other's, they don't share in revenue, but they share in goals. And so that relationship manager gets paid on the growth of the portfolio. So if the assets, increase, and we look at without market volatility, right? So if they bring in an extra $5 million, regardless of what happens in the market, up or down, we look at the net, and they're compensated for that.
So Frank, is the RM a banker?
Yeah, but they're a relationship manager, fully licensed. They do not sell.
Okay.
They don't make any recommendations. They
Okay.
can do a plan. They can have discussions and do all that. But they work for the brokerage firm. Like we manage them. So
Okay.
the same manager that manages the FA manages that individual, the banker.
Mhm.
Mhm.
Good. Okay.
So Peter, in the Wells Fargo world, they're going through an interesting transition and restructuring right now. So there's two distinctly different payout grids, one for the bank channel and then one for the wirehouse channel.
Mhm.
And with any of these comp plans, you can either use kind of the carrot or the stick approach. And at Wells Fargo, I think they do a pretty good job of using the carrot approach. And that is rewarding good behaviors as opposed to penalizing bad behaviors. So as a business, what is important? And if we look at the grid, the things that they will reward are revenue, so absolute dollar amount, segmentation, and it's that same threshold, that 250. But the goal would be at 75% or greater in 250 plus households, and then growth. One of the things that you highlighted was the fact that, on an average, they're bringing in 1.3 new households. Well, that's not going to help really grow the business. So they're using as a threshold about $150,000 of year-over-year growth. And if you do all of those things, then you qualify for some additional incentives. Another area is deferred comp, and you may be getting into that conversation at some point.
We are, yeah.
But the carrots that they have around deferred comp are similar. It's going to be revenue, but they also add in length of service, net asset flows, and to what Frank was alluding to, full balance sheet. So expanding the types of solutions that they're offering to their clients to include bank and trust products. Oh, and I didn't mention the payout. For the first $13,500 is at 22%, and then everything over that is 50% for the Wirehouse grid.
Yeah. And that's a little bit different approach than other firms tend to have, Larry. That's a pretty simple grid, isn't it? Right. What is it, 13.5? That, and then it's 50-50 at that point. And
it's basically 50%. That's correct.
Right. And then the higher you go, the closer it is to 50 in total. So it's a pretty elegant way to pay, having it that simple.
That's right. And there are ways to get to 50% payout from $1. Again, if you do all of the right behaviors, there are those additional incentives.
Good. Okay. All good input, guys. Let's Tim, let's move to Morgan Stanley.
Yeah, Peter, we had
Question?
a question on the
Okay.
The Merrill Lynch section before.
Okay, then let's answer that.
Yeah, I think so. This comes from Tyler Carr. How might Merrill Lynch account for market changes up or down in their AUM delta metric?
Well, one of the things I think you'll see throughout all these, and we'll really see it, and I believe in this Morgan Stanley compensation, is that the data that they have to be able to track this is much more than what we're accustomed to, in many of our bank programs. When we jump to the Morgan Stanley plan, we'll see that they're able to track it by client, the compensation by client. So not just total, but one client you might earn 36% on, another client because of certain things that you've been able to implement with them, you may earn 38% on, and it's at the client level. So I think to that question, it's that they have really invested in the data management so that they're not trying to have to, recreate or struggling to come up with data to pay in this fashion. Does that feel like it answered the question, Tim?
Yeah,
Or if not, we'll get you. We'll answer it more later.
yeah. Tyler chimed in to say thank you.
Nice. Okay. All right. Morgan Stanley. All right. Similar data points. 163 households per advisor. 208 million in assets per advisor. In managed assets in 2020, they brought in 5 million per advisor, 10.4 million in total assets. Compare those to some of the bank numbers that we have, of 7-8 million on average for many advisors in a bank, but there's plenty that are over 10. That's the average. Deposits a little bit lower than Merrill Lynch in deposits. There isn't the same focus apparently on it, as Merrill Lynch, 10 million versus I think was 17 million. And they did. I was able to get a loan number, 6.4 million per advisor in outstanding balances. So those have been accumulated over some length of time, but on average, that's how much they have per advisor. 15,000 advisors, a little bit higher average production at just shy of 1.25 million average production. So I think a couple things lend to this. I mean, Merrill Lynch has 3,000 advisors in their total that are those edge advisors, that probably don't have this same average. They don't have the same production or the asset averages. So that brings down some of the metrics when you compare Merrill Lynch to Morgan Stanley. But again, just to give you a feel for what, there's 15,000 advisors out there producing on average $1.25 million. They're in all the bank markets. All those 15,000 are all in the markets that, that everybody on this call's in. So, you need to know what it looks like and how they're getting paid. Okay, so let's look at their comp plan a little bit, Tim. All right, 41.5% at 500,000 and 45% at 1 million. They do have a length of service component that adds about 1% after $500,000. So those could be up slightly with that length of service over some period of time. They've recently, for this year, raised their production thresholds by 10% to qualify for the same payout. So, meaning if there's a payout level at 500,000, that's now 550 to get that same payout. So they've done that approach that, many of you all, I'm sure, have done in the past, is instead of lowering the percentage that an advisor gets paid, you change the threshold of where they have to produce to get that same pay. Morgan Stanley did it by 10% for 2020. And then here's the one part that I think is very interesting. Some things that, many bank programs have done to some extent is that there's an addition of up to 4% to the payout grid and 1% for financial plan for an account. This is at an account level. So if a particular account has a financial plan and that advisor is, let's say, a 45% payout, the payout on that business is 46 if they have a plan. So plans are important to them. Growing net assets in an account, once again, an account by account level by 5%, they can add another 1% to their grid for that account. Add 2 million of net new assets in an account, adds another percent. And if they get to 5 million for an account, it adds an additional percent. So, if we look at that $1 million, 45% of the million, if they've been there a number of years, it's 46% because of the length of service. And if they were happen to able to add all 4 of these, that brings you to 50% payout. So, again, it's in that 50% range, but it's not all production. Here they've got 5% of the 50 in that example that are things that are other than production. They're plans, they're asset-based, they're length of service based. Okay. So that's what I would say are the distinguishing factors in the Morgan Stanley plan. So panel, what do you think? Have any of you tried with paying more for financial plan? I know, a good number of firms, maybe, 20% plus pay for financial plans in the bank channel. Growing assets has been important. Growing assets has been important to firms, and some have put that in place as well as a compensation. Not as many have tied dollar amounts to it in the bank channel as this 2 million and 5 million are, but definitely for the growth of assets, that's been in plans. Was somebody?
I was Wells back in the old Wachovia and Wells days. They always did a great job with that with Envision. They tied it if it was a key household, you qualified for deferred comp, I believe it was. But we've tried to do it and we put it on a scorecard instead. Kind of going back to what you said, I think about the prior was paying at the account level. We're trying to do that. It's just very hard technology-wise for us to set up. Because we're trying to drive the advisors to go upstream, right? I mean, much of these accounts are 50, 100, 200, even up to 500,000. Look, in the very near future, they're probably going to be serviced by some sort of robo or digital solution. Not to say that the advisor won't be involved, but the margin's probably going to be a lot less. And the only way to differentiate is to do a plan. And does it really make sense to do a plan for somebody with $100,000? Maybe, but I don't know how you make money at that.
Yeah. Well, interesting, Frank. We're going to come back to that in a slide or two. But so you would say some of this is in one of you mentioned 7 management goals. So you would account for much of this in your goals, I would imagine, right?
Yeah, it would be, yes. I mean, but it's not as meaningful as like something here where you're getting a definitive 1% or
Right. It's not as direct tied to it. It's more discretionary.
Right.
Okay. Any others? Thoughts out
Yeah,
there?
Peter, we track it. We think it's a really important metric, and we strongly encourage people to do a plan. But we shied away from tying it to compensation because just didn't want to take away from the integrity of the planning process. Do a plan for the right reason. Too often I've seen when you tie it to compensation, people just do a plan for doing a plan's sake. And we wanted to make sure that there was integrity in the process.
Well said, Kevin. I mean, you're right. I mean, that's a waste of everyone's time, advisor, client, and firm. So you really want to get the most out of them. So very interesting. Good.
Well, and at Wells Fargo, as Frank mentioned, the Envision planning process is front and center all the time. And they call it POR, plan of record. And that's something that is measured on an ongoing basis and was rewarded with deferred comp.
Okay.
It's funny you mentioned that, Larry. We actually clear through first clearing, and we use Envision as our planning tool. Plans of record is something we were going to incent this year. The challenge was we know what the plan of record is, but tying that to our compensation and getting that to the account level is a little more challenging. So it's still something we'd like to do, but we have not implemented that yet.
Yeah. Data, is going to be difficult to get it at this granular level. There's, four different, length of service is a pretty easy metric, but these other 4 metrics are hard to track. And, think of how many clients it has to be tracked for under every advisor every year. I mean, that's a lot of tracking, but it's it's where the industry is. And that's why I think we need to look at firms like this, because if they're tracking it, we are going to have to track it at some point. We're going to have to get there. So we need to think about how we, how we manage our business, knowing that this is now a standard out there, or the bar to reach in the industry.
Yeah, it's interesting because we can do segmentation. We can identify households by asset levels, by key household metric, whatever we want to do. But actually identifying the households that have the plan of record, at least in our case, is a challenge. I don't know what it's like if somebody's using Money Guy Pro or someone else, but if you don't have your clearing firm data or your account information data flagged with a financial plan indicator on it, it's hard to tie it all together.
Yeah.
And also too, to avoid what Kevin was talking about, where people are kind of gaming the system or doing it to just check the box. I think that Wells has done a good job of putting some standards around it and having some inspection process around the number of client meetings, annual presentations of the plan, so that there's evidence that it's a process as opposed to an event.
Good. And we're finding more and more firms are actually reviewing the plans when the advisor submits them, or at least a number of them, or trying to review a bigger percentage of them, to make sure that it's not just a plan that's out there on a piece of paper or on the computer. It's actually a really helpful and legit plan, and then following up to see were those recommendations implemented. More and more firms are trying to move towards that to really give it some integrity. I think when we all started doing more plans, the last few years, it was more about, how many plans are you doing? And now, instead of just the quantity, there's a budding focus on the quality of those plans and the implementation and execution of those plans. So maybe we'll see more of that come out in the compensation in the future, instead of just the numeric tally, which is out there today.
And it truly is a great vehicle for uncovering other assets. We're all working towards full balance sheet, leveraging the other partners within the organization. And it really does a fine job there. I was shocked when I went in to start inspecting some plans of some of my biggest producers, and there was literally nothing on the liability side of the balance sheet.
Right. But they have all the client's business, right?
Absolutely.
100% of it. All the wallet share. You gotcha. All right. Last thing, then we'll move on from this one, is that, if your wealth and personal trust area isn't involved in this type of work, or working with us on this, or really looking at, this type of information, look at the last two bullets here: 2 million of net new assets and 5 million, in growing accounts by $5 million. Well, these advisors are not just going for the business that our bank advisors are going after. It's definitely in the space of where wealth management at the bank is trafficking as well. And that's their focus. And, you look at the incentive plan, it's continuing to move them upstream to compete, as we're moving upstream in the bank investment side, but it's continuing to compete with the personal trust areas within banks. Okay, Tim, we're going to cover one more firm here, and then we're going to break out on some key components of plans. So, all right, so here's UBS and the intricacies of their plan. So 39% paid at 500,000, 44 paid at $1 million, plus from 2 to 5.5% added for length of service and a production matrix. So they're viewing length of service as more than the other two firms. That's their angle, if you will, on this, is that length of service is really important to them. And then it's in this production matrix, which, if you can picture, you've got, let's say production across the top, and length of service going, vertically. And the longer an advisor is there and the more they produce, the closer they move to 5.5%. If they're there a long time and produce a little, they're closer to 2. If they produce a lot but are there a short time, they're closer to 2. But if you have both of them, a long tenure there and a lot of production, you move up from that 2 to that 5.5. So, you have to see the matrix, so to speak, to get the benefit, to understand it. But that's the concept behind it, is they want long tenured advisors that are producing a lot, and they reward for it, up to 5.5 on the grid. You put that on that 44, and again, it's getting pretty darn close to that 50% in a million. Okay. They raised their production thresholds on average 20% in 2021 to qualify for the same payout. So similar to what Morgan Stanley did, they did it by 20%. Now, they haven't raised it in 3 years, but still 20%, is a significant bump up. And then they pay a new money bonus. And this isn't in other plans as much, but a new money bonus from 1 to 5% of new assets. And half's paid in cash, half in stock, and it's deferred over 6 years. So they're putting a lot into this component. They're saying, new money, and they're going to pay, in cash and stock, which is a variable component of it. And then they're deferring it over 6 years. And that new money bonus, we'll talk about it in the deferred component some, but that again can add another 1 to 5. So, that advisor that was at 44.5 or 49.5 with their, their production plus the length of service, can add another 5% onto their, potentially another 5% onto their grid. So I thought those were the unique ones about UBS, in that, their grid is maybe a little bit lower, especially at 500, but 20% increase thresholds, and then this new asset component. So any thoughts on the new asset part of, paying for new assets that have come in? Anybody tried it? No? Well, we're going to talk about, we'll talk about it again, and I have a little bit more detail on it as far as how it's paid, in a future slide. So,
Peter, my one
Yeah.
thought on that though is,
Yeah.
and I'm not against it, but I feel like in a bank program, your new money, at least in our advice, I can understand it for the Wirehouse, but our advisors are getting referrals. Their new money is really coming from the bank. So I've never felt the need
Right.
to pay them for new money. Now, I suppose if I could segment it out, if it's not a bank referral and you bring in new assets, we've looked at giving kind of an additional bonus or different payout for that. But as it relates to new money, you'd almost have to do it for non-bank referrals, because if you're paying for new money, then it's really, if you work your branches well, you're going to do very well in that category.
Okay.
Well,
So, but with that, I'm sorry, go ahead. Is that
Sorry,
Fred?
Peter. I was just going to
Larry,
say that
sorry.
on the bank channel at Wells Fargo, we did have an incentive for outside money. So even though it might be a referral from your branch, if you found the money at Bank of America, that we can then track as outside money and give an incentive for that.
So I think this is a really interesting part of the discussion, because firms go 2 different paths on this. One is, you would say, why would you pay for this new money when it's coming from the bank anyways? And why wouldn't you pay for it, if it's coming outside of the bank, and pay more, if it's external? And I can see the case of why you'd want to pay for external, because you don't have that infrastructure that's providing a referral. But at the same time, what if one advisor brings in 20 million in new assets and another brings in 10 million in new assets from bank referrals? I would bet that the one that brought in 20 million did a better job at cultivating their referral sources, meeting with clients, doing all the things that they need to do And at the end of the day, they still brought in $10 million addition, in addition to what an average or another advisor would. So just because it comes from the bank, should you really not incent better performance is the question. I understand why you'd want to pay more for external because it's harder, let's say, than referrals. But do you really want to not pay more for somebody working in a bank that was able to garner a lot more referrals and a lot more assets and a lot more revenue than another advisor?
Well, Peter,
And I would argue, Peter, in that case, that they are being incented because that extra $10 million is going to move them up the grid. It's going to
Exactly.
qualify for a higher payout for deferred comp. So I think that they're being rewarded.
I agree with that.
Okay.
Peter, in any case, it looks like the paying differently for outside money is really going away. We looked at this as part of the study we did for BISA last year, for BISA, and hardly anybody pays more for outside money now. Whereas 20 years ago, it was, you might say 40% of firms did.
Yeah. Okay, good. Guys, I'm thrilled that you're bringing up these comments like that. That's exactly what the discussion we want to have, because, many times there aren't one right answer for it, but there's different degrees of the answer. And these are the exact comments that I'm hoping that we have on this discussion, because that's what this whole forum and this setup is meant to do. So thanks for these comments, guys. All right, Tim, let's find out what the next topic is on here.
Sure. Before I do, I'll just share
Is there a quick question or
comment that just came in from Kimberly Herbert. She thinks that maybe part of the reason why the trend on paying too much money is going away is that there's too much potential for gaming on new money. She also points out that there's a natural incentive for reps as they move up the grid. So just wanted to share that quickly. Thank you for that comment, Kehrer.
Okay. Okay, and then here are just some other notable 2021 compensation changes. Merrill Lynch pays 0% on the first 3% of production. So, so whatever an advisor produces, they earn 0 on that first 3%. And then their grid kicks in. So this is just meant to cover some fixed costs. They know everyone will meet, some dollar amount of hurdle. But you're not starting at, you're truly starting at 0, and you're starting at 0, a little bit after you started. So they withhold the first 3%.
So Peter, just to simplify the math, if you did 100,000, you get paid on 97,000.
97, you get paid on 97,000 because the first 3 is at 0.
Got it.
Yeah. No production credits for accounts under 250. I think we've covered that. And then deposits. We'll see this both for Merrill and Morgan Stanley, is that, they were paying 14 basis points. Merrill, and if we just drop down to that next one, Morgan Stanley was paying 15 basis points just flat out on deposits outside the grid. And those have now been reduced to 7 and 10 respectively. So, with the condensed spreads that are in the market, I think they're reducing their payout because of that. Plus there isn't the same deposit demand. And, I know many banks are feeling that as well until loans pick up. There's not as much desire as there has been in the past for deposits. So it's reflective in both these firms' plans on deposits. And then Morgan Stanley also has a 10% higher threshold for the same travel and expense. So what they do is that they have at different production thresholds, you're allotted different travel and expense budgets. And over certain thresholds, you're allowed to waive some fees for clients, annual IRA fees or things like that. To reach those thresholds, those have increased. So, more proof that they're all trying to move up, up market, in many different aspects, but both at the client level and the production, the average production level. Okay.
Now, Peter, we haven't heard much from Ying Lu yet. Perhaps you could fill us in a little bit about the world of structured products and cash replacement and what's going on in that world.
Yes. You're on mute. Ying Lu, you're on mute. Okay, I think I see.
Hey.
There we go. Good. All right, we can hear you.
All right.
We can hear you. Great.
Okay, sorry. So in the wirehouse space, I mean, infrastructure nodes, what we have seen a new trend in 2020 is what we call it as a cash replacement trades. This really comes as a result of the continuing rates rally that we're in such a low yield environment. So as a result, the interest rate the investors earn in their savings account is very minimal. And then this is the result of cash replacement trades and structured notes. In fact, this kind of trade actually attracted investors who are traditionally non-structured notes investors. And those are usually short dated, ranging from 1 to 1.5 years. They're principal at risk, but with deep barrier or buffer protection. And then pay a fixed or contingent coupon, usually in the range of 5 to 7 per annum. So it was a natural replacement trade for people who otherwise would keep money in their savings account. There's also another type of trade that has always had its place in wirehouses is principal protected notes and CDs. But for the same reason that we're in such a low yield environment right now, these trades are no longer priced. So we see very few trades in principal protected space in the market. Currently, Citi is partnering with WealthVest, marketing a 7-year principal protected note linked to a Fidelity multi-factor index. And I'm going to have I'm going to ask Fred Nicholas from WealthVest to talk more about this product. And we're going to have CDs linked to the same index family in the coming months as well.
Oh, thank you very much, Ying Lu. It's exciting. We're launching a Fidelity index. I believe it's the first of its kind, first to market of any mutual fund company bringing out an index. It's called the Fidelity Multi-Factor. It invests in all equities. Primarily in high dividend yielding stocks, and then it goes into other factors. It sets it, it's static, it rebalances in a year. There's a vol control overlay on the principal protected note of 5% in order to price it, bring it to market. And then we're hoping to have a launch of a market link CD with Fidelity Multi-Factor, Citi Market Link CD, vol control of 3.5% in March, optimistically, if not April. So we're very excited about it. WealthVest has a dedicated wholesale force to the Fidelity Multi-Factor Citi note and soon to be CD. And we launched it this last month, and it's received a tremendous amount of attention. The index goal is to perform in various market conditions, and it has performed to its objectives. It's done very well. So there you have it. Looking forward to bringing it out there. Thank you.
Thank you, Fred. Thank you, Ying Lu.
Okay, very helpful. Thanks. All right, well, that should add to these production thresholds. So That's good news. All right, Tim, let's advance one more. Smaller clients and lower producers. All right, nope, Merrill Lynch, no pay under 250. Merrill Edge houses about 3,000 advisors that focus on that affluent segment. As I'm sure many of you know, they receive primarily a base salary, and then they do have an incentive based on assets for both bank and investments. And, they earn another 20, 30, 35,000 maybe if they do well in that Merrill Edge role. And, maybe the opportunity to become a Merrill advisor, not in the Edge program, but in the Merrill advisor program. But this has really worked for Merrill Lynch. I've done some other work for firms on this, with a lot more details than what we're covering now, but it's really worked for Merrill Lynch in many different ways that they feel it's worked for them. So, it's very akin to our branch advisors as far as what they do. And then Morgan Stanley does a 10% payout on accounts under 250,000 without a financial plan. So where at Merrill, if you're in that Merrill Lynch branch office, you really can't have under $250,000 and get paid. Where Morgan Stanley does a flat 10% payout unless there's a financial plan. And their thought behind it is that the advisor will uncover more assets through the plan and get them above 250. And that's their whole reason for paying for a client that has a plan that are under 250. Because if they're, if they don't have more than 250, the advisor is not going to spend a lot of time with them. If they do and do a plan, they're going to realize how much is there, and then they'll put them on the regular grid with the hopes that client will have more money, bring it in, and they'll be above 250. So that's their play there, and how they handle it, to support that premise through compensation. They're extending the transition packages to a longer period than what they had in the past for new advisors. This isn't where they're paying upfront money to an existing advisor. This is to a newer advisor. And then UBS does a flat 30% payout to the advisor on accounts under 100,000 that were migrated to the centralized service unit, which is again a different approach. They pay the advisor for giving up that account, turning it into the centralized group. The advisor still gets paid, a decent rate, not even knowing what that advisor or what that client does, or not having really any engagement with them. Now, I think if I'm a UBS advisor, I'm wondering when that'll end, but it hasn't so far. So, unlike Merrill that just pays 0 under 250, unlike Morgan Stanley that pays 10 or maybe the grid under 250, UBS pays 30% to the advisor if they download the account. Yeah. So a couple different approaches out there. So
Peter, I'd be interested in whether there are other people in the audience that are doing that. Generally, we hear that people are not paying
right
either once they migrate the account. But
you mean the UBS approach? Yeah.
Right. Are there others out there who've clicked or called in where they actually are continuing to pay the advisor? We can kind of move the conversation on, so we'll see if we get any on the chat line on that.
Yeah, but even on the panel, I'd be interested to hear, the experiences that you all have had. I mean, the number keeps going up. I'm surprised that, UBS is at 100,000, but, the number keeps going up. I'm not going to be surprised when it gets above 250. I think it will. I'm sure I know firms have already talked about it, as far as some threshold, but any from the the group at this point? I don't see Frank on at the moment. I know he would have a comment on that. But
Yeah, we do not, Peter. We don't have anything like that.
okay. Well, more and more firms are having something in place to, to migrate clients to the call center. And, I would say most do not pay, but, here are some variations for you if you want to consider them.
And we've had one person chime in from the audience, Bob Cole, to say that they will pay the advisor on migrated accounts, but discourage unless the circumstance warrants.
Okay.
So kind of a discretionary payout, or maybe negotiating with the advisor, I suppose, right?
Yeah, and I know of firms that, that once it reaches the threshold, they're making plans to move it back to the advisor.
Right, yes.
So that's another common approach to it, is that, under 250, it comes centralized, but if the client does get above 250, it's still identified as that advisor's account, and it would go back to them. That helps because we know that many of them are going to win the lottery.
That's right.
Because they don't want to give them away, so that when the client does win the lottery, right back to them.
In one of our virtual dialogues a couple of times ago, Peter, Tom Dowd recounted his experience at SunTrust in trying to pay advisors, and he said it was a logistical nightmare to try to track it, and that's why, in his world, which I think was primarily annuities in a call center, they abandoned it.
Right. But again, it points up the need for better data management than maybe what our banks have given us to date to do some of the things that we're going to need to do to really stay competitive. All right, Tim, let's see, next topic. Deferred compensation. All right, what are these firms doing on deferred compensation? So deferred compensation is a percentage taken from the total grid payment, not in addition to the grid. So let's just chew on that for a moment here. With all three of these firms, or at least the first two, I should say, what they do is they say, here is the grid, and it, at a certain threshold, let's say it's 40%. And then of that 40%, a portion goes to deferred. Okay, so at Merrill Lynch, it starts at 3.5% and goes to a maximum of 7%. So, if a Merrill Lynch advisor is getting paid 44% on the grid, they're getting paid 44%, but 3.5% of it is getting deferred, and 40.5% is going to, immediate compensation. So the way it's positioned is that it's the total grid payment, and then a portion goes to deferred. Now, a lot of the banks that have this in place don't position it as that. A lot of banks position it as you get, a 44 or 40% grid payment plus 4% deferred, just to give you the alternate. So that's one of the things I really noticed in comparing the way that, wirehouses do it, which is it's all in the grid, and then they segregate a portion out for deferred, where the bank programs, most of them that do a deferred, position it as an add-on. And I thought that was just an interesting distinction that, that we probably haven't talked enough about in the bank space, because so many do them with this, 40 plus 4, 38 plus 3, whatever the number is. So at Merrill Lynch, it's 3.5 up to a maximum of 7. Morgan Stanley goes from 1.5 to 15%. Now, 15% is at probably 5 million in production. I mean, it's not your garden variety advisor that's getting 15%, but 7-8% they are, there's advisors in there getting 7-8% that are, producing a couple $1 million. You all have them in your shops, or, you probably have multiple ones in your shops that are producing that much. 3/4 in cash, 1/4 in stock. So they reduce their cost a little bit by having some of it in stock. But those are, significant deferral portions that are both components of the Merrill plan and the Morgan Stanley plan, especially Morgan Stanley, as far as one of the, variables that are in the plan. It's not just about grid. It's how they pay off the grid and how much is current cash and how much is deferred. UBS, a little bit different, this new money bonus that we talked about. And, from 1 to 5%, half in cash, half in equity. And, interesting there, they pay 1% on the first $1 million. So an additional 1% on the first $1 million of new assets that comes in. And then it's in tranches, let's say. So 2% from 1 million to, let's say, 10 million, but not retroactive to $1. So, 2% on the incremental amount above 1 million. And then, it might be, let's say, 3% on only the incremental amount from 10 million to 25 million. So, in total, you're not getting an extra, 5%. No one's really getting an extra 5% because, the first million's at 1 for everybody, and you have to build from there. It's not retroactive, but nonetheless, it's a new money bonus that, if you bring in a lot of assets, then it's meaningful. It's absolutely meaningful.
And
The highest threshold is above 100 million that they've just put in, and on that amount, so imagine that, an advisor bringing in 100 million, in a year, and the amount above that, they now pay 6% on the amount above that. So it doesn't seem like that one's going away. That one's caught their interest.
But this is additive on top of the grid.
This one is additive. Yeah, that's
the
what,
other two, right? Yeah.
the first two are really are
I like a hold back, right?
Yeah.
Mm-hmm.
Okay. So, any experiences that we've, that you all have experienced with the deferred component? I mean, the one I just shared is that most firms do it as an add-on instead of a reduction from.
Both of the Wells Fargo deferred comp programs are in addition to the stated grid, and are both meaningful additions. On the Wirehouse grid, we talked earlier, Peter, at 50%. The maximum opportunity on a deferred comp award would be up to 7.5%. So, pretty attractive number.
Right, it is. And how long? What's the vesting, if you recall, on that?
I'd have to. I don't remember that offhand.
Okay.
I want to say it's 7 or 8 years, but I'll.
Yeah. Okay, that's all right. Yeah, I just didn't know. But it's significant period of time.
And it also goes back to the things we talked about earlier in terms of the different things that are being rewarded. Revenue, length of service, net asset flows, and full balance sheet all work into the mix to determine the amount of the award.
Good. Okay.
5-year cliff vest. One of my fans out in the audience was able to help me out. I threw him a lifeline.
That was your one call, right? The one call you were able to make.
That was it.
Good call to make. All right. Okay. Thanks. All right, Tim, let's see if we have another topic here. Advisor teams. A lot of interest out there on teams in the bank channel. We get questions on it. We've helped some firms with it. So here are the components for Morgan Stanley and UBS. So Morgan Stanley, a team must be net positive in assets. Again, assets are a driver for all team members to receive the payout at the highest grid level. So, a team of 3 of us, each of us in our book has to have positive assets, not just total as a team, but each of us individually have to have positive assets. And if we do, we get the payout at the highest of all 3 of ours, in this case, grid level. So that's how they run the teams, is that, they pay everybody, or most everybody, probably at the highest grid level of all the team members. They pay each of them at that highest level. They have an alternative to that, or each team member must have 10% of the client base with the current financial plan. So a couple things on that I think are interesting is that, 10% may be higher than what some of us experience as far as clients with the current financial plan, but, it's certainly not 90%. So, I would say that threshold isn't that impressive. If that's how you're able to get the highest grid level of all the team members is at 10% of your client base, I just think it's interesting that 10% isn't that high.
Yeah.
And it shows it's important to them. And it also says if you're not growing assets, you probably need to do a plan. I think that's the message there. So interesting.
Yeah, especially since, their client base is like 150 clients or 200, right?
Right, 163, I think is what we
And
saw.
so that's 16 plans, right?
Yeah.
Yeah. And that's, awful lot of people, awful lot of reps in banks do, 100 plans a year, right?
Yeah.
So, yeah.
So, just some insight for you to use on that. UBS teams must generate a combined 6 million and have average advisor production of 1.2 million to qualify. So they don't want small advisors in a team, in total, like they don't want a bunch of small advisors coming together. So they have that 6 million threshold. And then the average production of 1.2 million means that you're going to have some higher producers in there if you have some lower producers in there. And both of those thresholds, you can see what they're up from in 2020. They're up significant thresholds. And that's again to qualify for the highest grid level of any of the team members. For all the advisors to qualify for the highest grid level of any of the advisors in the team. UBS as well has an alternative, or the team must produce 3 million and each advisor produce at least 900,000 for all advisors to receive the grid level of the highest producer. Oh, so the top one is to be on a team at all, but they do have these lower thresholds to receive, some level of a higher grid number. Again, up from 2.5 million and up from 750 to 900. So they all want higher production, and a lot of advisors and wirehouses are on teams. There's still some out there that are, just themselves, but there's more and more advisors, and in your shops as well. I mean, I know that, some of you on this call have, many advisors on teams, and it's some of the highest producing advisors, and they all want the highest grid that they can possibly get, from that lead team member. So Morgan Stanley and UBS are both trying to give them ways to do that, but they have requirements. So teams, any thoughts on teams that are, that you all have tried? Or from the audience that want to share a team story?
When we looked at teams a couple of years ago, Peter, the firms that participated in that study, 35% of their advisors were in teams in banks.
Yeah, and if that was 2-3 years ago, Ken, it's north of 50 now, I would bet. if it
But
was
that-
35.
But that was of banks that had teams of the, but only coincidentally, only 35% of the 70 firms in the study had teams. But for
Right.
those who had teams, 35% of their advisors were in teams. So you either were really into teams or you weren't at all.
Yeah. Yeah. Okay. All right, Tim. Do we have another? We do. We have retirement. So this is when an advisor, is ready to leave. How do they transition out? And I was able to see the Merrill plan, and that's what they do is they pay from 105% to 200% guaranteed, and the firm pays plus up to an additional 40% for growth. And it's 5 years and a 50% grid credit to the inheriting advisor. So let me expand on that here just a little bit. So many bank programs have asked for, how to transition advisors out, and we've provided some research on it. We've consulted with banks on how to do it. This is an option out there. Most bank plans have, a retiring advisor and an associate advisor that pair up, and they split the revenue over 3 years or 5 years. We've gone over this in other settings, and the firm is not really involved other than to be the facilitator of it.
Mhm.
They split the comp the way it's supposed to go. There's documents that the firm does, but the firm's not in the middle of the transaction. It's a transaction between two advisors. So the Merrill transaction, the firm is in the middle of it. And so the firm pays, 105 to 200 to the retiring advisor, just flat out. And then, this additional amount, depending on how much the business grows over this time, this 5 years. And then the receiving advisor, that advisor that inherits the book, gets a 50% grid credit for 5 years. And then after 5 years, it's 100% theirs. But for 5 years, they're working for half the grid credit, and then, but building the assets, and then for that payoff that's down the road, and then the savings that Merrill gets on not having to pay the advisor on half of that business, goes in to help, offset this 105 to 200 that the retiring advisor received. So they're very much in the middle of it. And, an alternative, and, one of the alternative ways that we mentioned, but I see very few banks that, that actually implement it along these lines.
So that, if I understand this correctly, then that the sort of that unit, the retiring advisor and the inheriting advisor, that's sort of pretty much underwater for the 5 years from the point of view of the firm. I mean, the firm is essentially paying up front to keep the business from going away.
Right.
Yeah, right.
Right. And that's one of the reasons that a lot of bank programs don't usually do it, is that they want it to be revenue neutral.
Right.
Where, this is potentially, I guess you have to compare it to what, but I mean,
right.
If the client leaves, it's revenue additive, but, if the advisor stayed, it's probably revenue neutral, revenue negative. Whereas in the bank programs, it's a wash. I mean, you're just dividing up the same dollar to different people, different ways over different years. But similar to the way that, recruiting's done, I mean, they'll pay, Merrill Lynch will pay 200+% to bring the advisor in, which, is hard to, it's in many ways, it's hard to justify financially that transaction. This, the back end of their career isn't all that different to have to justify. If you can do it on the front end, you can do it on the back end, I guess is.
Well, the research we did on this indicates that if you lose an advisor, even if they take no money with them, just
Right.
walk away, you're really, you've just lost $1 million. No matter how you
Right.
slice it.
Right, even two, I think it is, Ken. I think it's
Yep.
2.1 or 2 million. Yeah,
That's right, because
that's a good recall on that. Exactly it.
that's right. So
So-
that you,
It depends on what you compare it to. I mean, yeah, you're paying a lot out, but and it probably isn't zero. But I think firms see if they lose that advisor, the advisor's there, 5, 6, 7, 8 years. You're not going to lose a lot of the assets. The firm keeps it in many cases. 20 plus years, you lose an advisor that's been there for 20 years, and there's a number of them out there. Most are all producing over $1 million. You do lose more than you're used to losing when that advisor is very very tenured with your firm. So
but the real cost is not just the money that goes out the door. The cost is the money you would have made if the advisor had kept with you and producing, because the new
That's right.
advisor is not going to produce anywhere near what the retiring producer produces.
Right.
And that gap is something you'll never get back. And
Right.
that gap, year after year, that gap will exist, and it'll be dragging down your P&L.
that's right. It stays in place forever because they never close it.
That's
So,
right.
now these folks may be in a little bit different situation. They don't also have the bank in many cases to help retain that relationship and that client.
Mhm.
So, chances are the advisor and the clients probably do tend to move more with the advisor in a Merrill Lynch arrangement than they do, in one of our bank programs. But again, what this was really meant for today is not to say, how do we make our bank programs necessarily more like Wirehouse plans. It's to fully understand what the objectives of Wirehouse plans are so that we can be smarter in designing our bank programs, our bank plans to do what we want them to do, and to use the learnings from what the Wirehouse has invested in compensation to help us make those decisions. So we covered a good amount of topics, different firms, different components of the plans. As you think about compensation this year, more and more firms are adjusting their compensation. They're working on it, in the second quarter so that they can have it approved and ready to go in the third quarter to roll out in the fourth quarter to have it right for next year. So we thought it would be very timely to talk about what's recently occurring with compensation so that if you're thinking about that, now's the time to start it, and we're here to help you start it.
And Peter, before you sign off, I thought I'd just throw out for the good of the folks on the call, Wells Fargo is very aggressive and I think very creative in this space around basically asset retention, FA retention, and it's called the Summit Program. So you can Google on that. There have been a number of things that have been written up about it. But the bank advisors are also eligible for this. It's very lucrative for the retiring FA. It's very lucrative for the acquiring FA, and it's very lucrative for the firm for all the reasons that you just described in terms of not losing revenue, not losing assets, and not losing clients.
Good. Thanks for including that, Larry. Appreciate it. Okay, Tim, we're about that point. So I'll say it and you can say it again, but we do want to thank WealthVest Citi as our sponsors for this today, as well as Terrapin and Delaware Life for presenting sponsors and being part of it to support our efforts in it. So, and I especially want to thank the panel. Great discussion, important topics that we've got to get right. So thanks for the discussion. Hopefully the attendees that were able to participate through dial-in were able to bring away what you need. And, Ken, Tim, and I are always available for y'all. So thanks to the sponsors, panel, attendees. Tim, wrap it up for us.
Yeah, just once again, thanks to everyone who helped to make today possible. We hope that all of you in the audience will consider joining us at a future virtual roundtable event. Coming up next on February 23rd, we're going to have a webinar focused on improving advisor productivity. In March, on March 11th, we'll be rolling out this year's edition of the annual industry checkup. We'll have a virtual event to discuss those findings. On April 13th, we'll have an event on growing advisor headcount, always a popular topic. In May, we'll be looking at developing holistic advisors. Over the summer, Peter will be working on our biannual survey of FA compensation. And in the fall, we hope to be able to transition back to doing our study groups in person, or perhaps adopting kind of a hybrid model where we have some people physically in the room, and then those who can't join us in person are able to do so virtually. So thank you for joining today. Hope to see you again, and take care, everybody.
Thank you.
Thank you.
Thank you.
Thank you.